Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Running out of steam, the rally takes a rest as billionaire hedge fund boss Steve Cohen says the odds of a US recession now stand at 45%. We'll get Jamie Dimon's take in our exclusive interview with the JP Morgan CEO later today. Putin's snub. Russia's president says he's sending low-level officials to today's Ukraine peace talks with no sign he'll attend in person. And the art of the deal. The White House says President Trump has secured deals with Qatar totaling over $240 billion, including a record order for more than 200 Boeing planes. Good morning, happy Thursday. Checking in on some earnings stories crossing right now with a focus, of course, on the conglomerate in the industrial space. Siemens coming through with second quarter industrial business profit rising 29% year on year to 3.24 billion euros. The stock, as you can see behind me, is up about 20% or so year to date. Second quarter orders coming in above the estimates. There's a beat on second quarter orders for Siemens, coming in at 21.6 billion euros. The estimates had been for just above 20 billion euros. In terms of revenue for the second quarter, also a slight beat, 19.76 billion euros, close to 20 billion euros in the second quarter. The estimates had been for 19.3 billion, so it's a beat on the revenue front as well. In terms of second quarter net income, coming in at 2.25 billion euros, that's an increase of 11% year on year. In terms of the industrial business, you're looking at a second quarter 300 million euro gain on an exit from one of the businesses there. Clearly, this is an industry, this is a business that is exposed to the trade tensions as well. The China part of the business will be in focus, and we're going to be speaking with Siemens CEO Roland Busch. 6:45 a.m. London time. You will hear that interview on the back of those earnings. Again, a beat on some of the top lines coming through from Siemens. Modest beat, but it is there, it seems, for the second quarter. Let's get to the broader picture across these markets. European futures currently pointing lower by 0.2%. You did see another day of gains for US markets, a little bit more muted, but the gains were there. In terms of the futures picture, S&P E-minis pointing lower by 0.2%. Nasdaq 100 futures, after the strength that's come through, particularly for the tech names, now giving up some of that. Looking for direction, fresh direction again, it seems, for these markets. You've seen a bit of softness over in Asia as well. We'll get to that shortly. FTSE 100 futures currently flat as well, also range-bound in the session. Let's flip the board and have a look cross-asset. Arguably a lot more interest in terms of what's happening within the FX space, but also fixed income as well, given the yield higher story that we saw across the Treasury curve yesterday. 453 right now on the benchmark US 10-year, largely unchanged in today's session. But again, you saw selling on bonds, particularly at the 30-year level as well. The 10-year now at levels we haven't seen for about a month. The 30-year closing in on 5% as that bill around taxes and tax cuts in the US makes its way through the legislative process. Euro-dollar at 111. Brent trading at 64.58, falling 2.3%. We'll break this story down for you on stories and suggestions that Iran maybe is getting closer to the US on some kind of agreement. And gold trading at 3,140. The yellow metal down 1.1% as investors question whether they need that haven hedge. Let's check in on the Asian markets then. We've talked about that softness, but arguably again, it is about the currency space. So you're seeing strength for the Japanese yen. You're seeing strength for the Korean won as well. On reports that maybe the Koreans have discussed with their US counterparts the question of FX and currencies. Is this the Trump administration that ultimately wants to see that softer dollar? So the won is up about 0.5% over in Korea. The Japanese yen is also gaining around 0.4. The Nikkei then under pressure on stronger yen, currently down 0.8%. And broadly across the regional index, you're seeing losses of 0.3%. Let's get to the Middle East right now and President Trump's continuing visit, of course, because the White House is touting the president's quote-unquote art of the deal on the second leg of his Middle East tour. It says Trump has secured deals worth more than $243 billion with Qatar, including a $96 billion plan for up to 210 Boeing planes.
Kelly's telling me from Boeing that's the largest order of jets in the history of Boeing. That's pretty good. That's fantastic. So that's a record, Kelly. And congratulations to Boeing. Get those planes out there. Get them out there.
Well, Horizon's Middle East and Africa anchor Boujnah Pasechi joins me now from Abu Dhabi and, of course, has been following all of this at a granular level. Boujnah, run us through the deals that have been announced then from Qatar and what we can expect today in the UAE, where you are, of course.
Yeah, so Qatar literally rolled out the red carpet for President Trump yesterday. The Emir himself greeted President Trump when he landed. This is actually the first time a U.S. president has visited Qatar in a state capacity. So it was a really big deal for the Qataris. But again, deal making, the focus of some of this trip, and the big headlines came through a $1.2 trillion economic commitment. I should just say that this is a commitment as opposed to an actual amount of investment that's being pledged. But what we do know in terms of actual deals, there's been more than $240 billion worth of deals signed between the two countries. And of note, that massive Boeing order that came through from Qatar Airways yesterday. We spoke to the CEO of Qatar Airways a few weeks ago. He hinted that an order was coming, but perhaps not of this magnitude. The White House saying that this is the largest Boeing order ever for any airline to make. The value of that deal, per the White House, is about $96 billion, though, of course, we know that airlines tend to negotiate discounts. So unclear exactly what the clearing price was. The White House also saying that the order will support more than 150,000 U.S. jobs, bringing a total 1 million jobs in the U.S. over the course of its production and delivery. So a significant event also for Boeing yesterday. The stock has seen a turnaround over the course of the last few months, but also is a reaffirmation of Boeing's position within the airline industry. And it was also notable, Tom, that the Boeing president himself was there for the signing ceremony. He has been accompanying President Trump on this tour around the Middle East. So that was on the airlines front. We also got a deal on the defense side of things, Raytheon, a $1 billion deal in order for them to sell counter-drone defense system to Qatar. So that's a $1 billion deal. All in all, it adds up to about $240 billion per the White House release. And of course, Qatar has a strong military strategic alliance with the U.S. Later this morning, the president will be visiting the Al Udeid Air Base before making his way here to Abu Dhabi, where we can expect more deal making, and perhaps on the AI front, Tom. I know you're going to pay close attention to that too.
Yeah, and I was just looking at the pictures, the pomp as well, being rolled out for the president in Doha with that red carpet and the camel riders as well. Pretty remarkable pictures. And I expect and hope, of course, that Abu Dhabi has done the same for you, Boujnah. Meanwhile, of course, and you pointed this to us, of course, in recent days, geopolitics, a big overhang as well in terms of how it filters through for these conversations. Iran, Syria, the US president meeting with the new Syrian leader. Talk to us about what President Trump has been saying when it comes to Qatar's role on the question of Syria and Iran.
Yeah, the main event on that front was that GCC Leaders Summit that took place in Riyadh. Also a historic moment because the Saudis had invited the Syrian President Ahmed al-Shara to attend. And actually, President Trump and the Syrian president, had a 30-minute bilateral one-on-one. This is the first time the Syrian president has met with the U.S. president in over 25 years. Significant, notable, of course, coming on the back of President Trump's announcement that they're looking to repeal sanctions on Syria. So there have been major there has been a lot of diplomatic progress made on that front. We were speaking to a sanctions specialist earlier, though. He says it remains unclear, though, exactly the scope of the sanctions and how quickly some of those terrorist still designations, how quickly it will take for those terrorist designations to be removed. But on the Iran front, again, some progress there. We know that Qatar has been serving as a major mediator in these diplomatic talks with Iran and its proxies around the region, including Hamas as well. Yesterday, President Trump appealed to the Emir in helping with the Iran-U.S. nuclear deal discussions. And we have to go back to what President Trump actually said at the GCC Leaders Summit. And I think this is interesting because it lays the framework for how the U.S. are thinking about this. Not only do they not want to see Iran develop a nuclear weapon, but he also was quite adamant that Iran has to stop supplying and supporting their proxies around the region. So there are two requirements from the U.S. perspective in order to continue with these deals. Some comments coming through an interview conducted by one of the advisors to the Ayatollah overnight suggested that they are willing, the Iranians are willing to not develop a nuclear weapon in exchange for sanctions relief. There have been 4 rounds of talks between the two sides, so there certainly is progress on that front. You're seeing a bit of a knee-jerk reaction in oil markets today on anticipation that there could be a deal, but still a lot of daylight between the two. And then questions about what exactly this deal will look like in comparison to that famous 2015 JCPOA deal that Trump actually pulled out of at the beginning beginning of his first term. So progress, but unclear at this point what the final contours of the deal are going to look like.
Yeah, and we'll get more on those oil market moves as well on the back of those lines. As you know, Horizon's Middle East and Africa anchor Jemana Pesechi, excellent update out of the region, continuing, of course, to follow the president's visit. Thank you. Now, staying on geopolitics, Russian President Vladimir Putin has named a group of low-level officials to join peace talks with Ukraine in Turkey, giving no indication that he plans to join the negotiations himself. US President Donald Trump has downplayed the chances of him joining the gathering. For more, let's bring in Bloomberg's Tony Halpin, who is in Ankara, Turkey. Tony, Putin waited then until pretty late to name his delegation. What do we know about them? What does it tell us? Was he ever planning, really, on showing up?
This morning, Tom, yes, the Kremlin basically kept us guessing all day during Wednesday to see who Putin would eventually name and whether he himself would go. As you said, in the end, there was no announcement of Putin coming to Istanbul for the talks, which was a condition that basically Ukrainian President Vladimir Zelenskiy had set out as a reason why he would go to the talks. Instead, he sent a group led by Vladimir Medinsky, who was in fact in charge of the previous time Russia and Ukraine officials got together in Istanbul way back in early 2022. Russia claimed at that point that they had some sort of a deal that Ukraine had signed up to. Ukraine said that that wasn't the case. Those talks broke down. And essentially, Putin is saying he wants to resume the talks at that point where they broke off by sending not only Medinsky as the leader, but also a deputy foreign minister who was part of that group. And there's a deputy defense minister also going along today. So as you say, pretty low-level people, not really empowered to make decisions. And that's going to be a disappointment, I think, for Ukraine and potentially also for the US, which would put some store on these talks.
Antonio, of course, you are on the ground for us in Turkey, where foreign ministers, NATO foreign ministers, will be meeting today. What will be the focus of those discussions?
Yes, they're gathering here in the resort of Antalya. They've got an informal summit where they're discussing, among other things, sharp increases in defence spending by NATO member states. So there's a plan on the table to increase overall spending to something like 5% of GDP. That will be broken down to something like 3.5% on actual defence spending, and then another 1.5% on things that are defence related. It has to be said that no NATO member is currently at the 5%, and very many of them aren't anywhere near the 3.5%. So it's going to be quite challenging for a lot of member states to reach that level of spending.
OK, Bloomberg's Tony Halpin on the ground for us in Antalya ahead of those meetings. We appreciate the update, Tony. Thank you. And we'll get more, of course, from Tony through the rest of this week as he reports out that story for us. Now, Steve Cohen says the chances of a recession in the US now stands at about 45%. The billionaire hedge fund boss says he does not expect the Fed to cut rates right away because, quote, they are going to be worried about inflation from tariffs. This comes as the Fed's Mary Daly says the economy's strength allows policymakers to be patient.
When you step back from the uncertainty and you look at where we are, we've got solid growth, solid labor market, and declining inflation. So we have ourselves in a good position to respond to whatever comes. Right now, the word of the day is patience. Patience to see, not guess.
OK, let's bring in Bloomberg's Valerie Teitel. So 45% from Steve Cohen. I want to know what his previous percentage was, which would put that into context, wouldn't it? I don't know if he's gone from 50% or 60% down to 45%, or if he's gone from 40% to 45%. Anyway, he thinks it's about 45% chance of a recession, which is obviously not negligent. But recession fears have eased somewhat in terms of how the markets are thinking about the impact on the US, given the détente between Beijing and Washington.
Yeah, that's right, Tom. If we look at poly market betting odds of a U.S. recession this year, they have dropped tremendously ever since Monday's de-escalation with the trade with China. You also see that reflected in the front end of the bond market. Two-year yields have risen some 16 basis points this week. This is the market continuing to price out Fed cuts. We're now pricing in less than two cuts from the Federal Reserve through the end of this year as the recession fears have really been evading. So that's the kind of story in the front end. Now, there is a similar story going on in the long end, but it's for different reasons. We've seen 30-year yields creep higher this week. Actually, on the Asia Open, 30-year yields touched 4.98%, Tom. We are coming a whisker away from that key 5% level that we hit earlier this year twice already. And that second one really caused a rethink of the Trump administration as to their tariff policy and maybe push them to do that 90-day pause on reciprocal tariffs. But what's driving the long end? A lot of market participants saying it's actually this tax bill that's making its way through the House. The bond market is clearly telling us this might be too much spending included in this tax bill. Might push the debt to GDP higher, might push that debt deficit as a percent of GDP maybe more than 2% higher than previously thought. So keep an eye on the long end. It might just ruin the equity market party for now. It is overnight. We have S&P futures in the red. They have snapped now 3 days of gains. We're still looking at, at least in the last 4 sessions since the start of the week, we're still up pretty decently on the equity market, but it looks like that equity market rally is taking a pause for now, perhaps driven by this rise in long end yields.
OK, great linkages between what's happening in terms of the sell-off at the long end in terms of treasuries and what that means for the equity markets. Watching that 5% level then for the 30-year. Valerie Teitel, our markets reporter, with the update. Thank you. Welcome back to Bloomberg Daybreak Europe. Oil is falling for a second day after NBC reported that Iran is willing to give up nuclear weapons in exchange for sanctions relief. Crude was already under pressure due to oversupply concerns and global trade tensions. Let's bring in Bloomberg Asia Energy editor Stephane for the latest in terms of the market moves around this story. Stephane, what impact would an injection of Iranian oil into these markets have more broadly in terms of prices and market adjustments if and when we get any kind of deal between Tehran and Washington?
I think the key word is if and when. But if we were to add more Iranian oil to the market, that would add quite a bit of downward pressure. They're a major supplier. Their supply has been restrained because of U.S. sanctions. Not totally. They have the dark fleet, and they've been able to still get barrels onto the open market. But still, it is something that if you remove those restrictions, you're going to see quite a bit more supply, hundreds of thousands of barrels of more supply of crude oil in the market. And this comes as OPEC Plus is also ramping up their increases, right? For the last 2 months, they've made decisions to add more to the market. Now, have they actually hit those targets? Not exactly for the last month, but still the rhetoric is there from Saudi Arabia to boost supply. Meanwhile, we're also in a period where demand is in question. A week ago, if you asked me about global demand, I would mention the trade war and how that threatens demand in places like China, as well as the United States. Now, with potentially the trade war easing, there are more questions about where demand will go, but still, you're facing quite a soft market, especially since Brent is at that kind of $65 level and could potentially fall down into the $50 level if Trump continues to push policies like an agreement with Iran.
We get the IEA energy report later today. What are you looking for from that outlook?
What are they going to say about the trade war? Are they seeing any meaningful impact to demand because of what's been happening there? And what's their outlook for oil demand going forward if they do unwind some of these tariffs against China and other places? Would this result in a rebound in demand, or has the damage been done and consumers are going to be cautious? I think that's one to watch. And also, what is OPEC Plus going to do with their output, and where should we actually see oil barrels coming out of those countries?
OK, looking ahead to the IEA report. Stephane Straczynski, thank you. Excellent update on these oil markets. Don't miss our conversation, by the way, with the International Energy Agency's head of oil markets, Toro Bossoni, at 9 a.m. UK time. Now to some other stories making the news this Thursday. Saudi Aramco has signed up to $90 billion worth of deals with US companies following President Trump's visit to the kingdom. The oil giant says the pacts cover partnerships on LNG, chemicals, emission reduction technologies and AI. MOUs were also signed with ExxonMobil to upgrade a refinery and with NVIDIA on AI infrastructure. French President Emmanuel Macron has accused Israel's Prime Minister of shameful behaviour in blocking aid to Gaza and called on the EU to toughen its stance against the country. Benjamin Netanyahu said Macron was echoing Hamas propaganda. Israel blocked assistance to the Palestinian territory in March, recently embracing a US plan for a phased resumption of food distribution that would stop Hamas seizing supplies. It is unclear, though, when the programme will start. The United Nations, of course, in their report have pointed to the possible risks around starvation in the Gaza territory as well. Around 2 million people living there. Meanwhile, US Capitol Police say Ben & Jerry's co-founder Ben Cohen was arrested on Wednesday after disrupting a Senate hearing to protest US military aid to Israel and conditions in Gaza. Cohen wrote on X, quote, "I told Congress they're killing poor kids in Gaza by buying bombs, and they're paying for it by kicking poor kids off Medicaid in the US." Coming up, Boeing seals a record deal to deliver hundreds of planes to Qatar Airways as President Trump continues his Middle East investment push. We're going to break down the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. President Trump giving Boeing its wings back with a record $96 billion deal for wide-body jets. For more, we're joined by our aviation reporter, Daly. Danny, talk us through this, what seems to be a huge order. How significant is it really for Boeing and for Qatar Airways?
Yeah, the Trump administration touting this Qatar Airways order as the biggest in Boeing's history, worth $96 billion in terms of the commitments and order purchases for up to 210 Boeing wide-body planes here. So this very much puts Boeing in front. It propels them, compared to, say, Airbus in the European context, this competitiveness between the two duopolistic plane makers. And so, yeah, it gives Boeing a real boost as its shares rallied 50% from an April low. It has been through an extraordinarily tough several years, and with the effort that Trump is making to try and boost trade and to almost simultaneously save Boeing, there is a lot being done here, and particularly as Trump flies around getting deals done on tariffs and trade. There's been a lot there left on the table for Boeing, and not just Boeing and Qatar Airways, but the deal was done in Saudi Arabia and with London simultaneously as well. So this is a big deal for Qatar, and as you can see, just the positioning, trying to build out an aviation powerhouse from the Middle East there.
Yeah, so on that aviation powerhouse, Danny, where does it leave the competitive dynamics across this industry?
Yeah, I mean, for Qatar Airways, it's going to be relying a lot in future on Boeing, and it already has 250-odd aircraft in its operations, mostly, Boeing, and going forward, that's going to really accentuate. And given the fact that the 210 plane order, up until 2010 through to 2025, Qatar Airways ordered roughly 210 Boeing planes. This order doubles it. So very much a big boost here, and very deliberately, given what's been done with the efforts to try and drum up even more trade and all the big numbers that have been talked about during Trump's tour of the Gulf region. So there's a lot of eye-catching numbers that are flying around quite literally, and so now it's up to the plane makers, particularly for Boeing, to deliver them going now and into the next decade.
Okay, really helpful framing for us from Bloomberg's Daly on this aviation deal, of course, with a focus on Qatar Airways and the upside coming through from Boeing as well. Coming up, do not miss our exclusive interview with the Euronext CEO, Stephane Boujnah, after the stock exchange group posted a first quarter earnings beat. We're going to be asking about flows from the US to Europe, but we're asking, of course, about the focus on making Europe more competitive when it comes to its capital markets. Stay with us for that interview. It's coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. Happy Thursday. I'm Tom McKenzie in London. These are the stories that set your agenda. Running out of steam, the rally takes a rest as billionaire hedge fund boss Steve Cohen says the odds of a US recession now stand at 45%. Putin's snub, Russia's president says he's sending low-level officials to today's Ukraine peace talks with no sign that he'll attend in person. And the art of the deal, the White House says President Trump has secured deals with Qatar totaling over $240 billion, including a record order for more than 200 Boeing planes. Let's get to the markets then. As we said in the headlines, the Trump relief rally as a result of the easing of trade tensions seems to be fading, at least around the edges. European stocks yesterday snapping 4 straight days of gains, ending lower by the end of the session yesterday. And today, European futures pointing off by 0.3% as well. Similar story over in the US. You did have 3 straight days of gains and a strong session again stateside, with the gains coming through, particularly for the tech names in the US. Nvidia back in positive territory for the year by slim margins. S&P futures pointing to losses of 0.3% now, though. Nasdaq 100 futures looking to drop around 47 points. Here in the UK, FTSE 100 currently flat. Let's flip the board and have a look cross asset, because arguably there's a little bit more focus in terms of the FX markets, in terms of interest and what is happening across the Treasury curve as well. With yields up yesterday, today a little bit of stabilisation, but you're at 4.53, the highest level on the 10-year yield in about a month. The 30-year closing in on 5% as well, on concerns about the deficit stateside. Euro dollar at 1.11, closing in on 1.12, a little stronger by 0.1% on dollar weakness in the session today. We're watching those Asian FX currencies as well, on speculation that FX will be part of the trade conversations between, for example, South Korea and the US. Brent down 2.3%, 2.5% for Brent. Oil prices softer on Iran comments, and gold also down 1.3% so far in the session. Let's get back to the earnings story and what's happening in these capital markets. Euronext posting record quarterly revenue on the back of recent market volatility, echoing a boost seen by other exchange operators. The European Bourse reported first quarter revenue up 14% year on year and ahead of estimates. For more, we are joined exclusively by Euronext CEO Stephane Boujnah. The stock is up about 37% year to date. There's a beat on the earnings. Stephane, are you seeing similar volatility in the current quarter? Is that a trend that you could expect to continue?
Well, as you said, this is a very strong quarter, but you should bear in mind that this is the 4th quarter where we have a double-digit growth. So the feeder or the driver of this outstanding performance goes far beyond the particular volatility of the last quarter. What you can see since the beginning of April is for sure the same dynamic. So we are confident that for the part of our business which is volume driven across the various asset classes, equity, fixed income, power, commodities, forex, we are seeing very similar trends since the beginning of this quarter. So we are confident that for the volume part of our business, we are on the right track for the second quarter of the year. Volatility is going to remain similar.
Sorry, you think it's going to remain similar through future quarters as well? It's on the right track in terms of volumes for the second quarter. Do you see that story pushing out into Q3?
I don't know. A part of the volatility that we are seeing on equity markets is driven by the volatility of political decision-making in the U.S. So the U.S. administration is feeding volatility in decision-making, is delivering volatile news flow, and this volatile news flow driven by volatile decision-making is driving volatility in markets. So that the metric to watch is whether there is a stabilization in volatility of decision-making or whether it's the new normal.
And you've talked about the unwind, at least for some investors, out of the US and into Europe, even mentioning in a recent interview movements of physical gold out of the US into Europe. Is that a trend that is continuing, Stephane?
Well, people who do move physical assets from the US to the rest of Europe do not make a lot of noise about it, and they don't communicate publicly about it. What I can tell you is that as the US is developing in a way which is not really recognizable compared to the environment that we were used to, as the rule of law is being shaken, as the decision-making is being fundamentally redefined, some investors are revisiting the way they allocate their global assets, and many investors across the planet are either moving their assets from the US to the rest of Europe or not renewing their investment or reducing their exposure to the US until the dust settles. This is real, and that translates into valuation of private assets in public markets, and also in terms of location, physical location of physical assets, like who is the custodian of securities and who is the custodians of physical assets like gold. So this is happening, although people don't communicate about it.
And this seems like a perennial question now, Stephane. When do the IPO markets come back?
Well, the IPO market, the pipeline for everyone is relatively thick, but there is a drought, there is a sort of stop in the market, which everybody understands, which is driven by the unprecedented, sustained level of volatility in equity markets. And when there is so much volatility, no one goes to public markets for IPO. We don't have many IPOs in the US, we don't have many IPOs in Europe. I'm confident that as soon as volatility will go back to sort of a sustainable level for equity primary issuance, we will have a significant number of companies that will go public. At least we have two big phenomena in Europe. Massive number of tech companies that are ready to go public, and many companies revisiting completely their appetite or initial interest for listing in the US. Going listing in the US carries now a sort of regulatory and political risk that was not around 1 year ago. So not everyone is weighting the balance between higher valuation multiples versus more political uncertainty and more regulatory uncertainty in the same way as 1 year ago. So things are changing, and we have a very significant interest of global companies that want to be listed on the Euronext single market, just because this is a market which is twice the size of the London equity market, which is twice the size in terms of both volumes and aggregate market capitalization. So the liquidity of European markets aggregates now on a market, and that's why we have so much appetite for global companies that want to be listed in Europe now.
Okay. Stephane, you always have to take a swipe at poor old London, Stephane. How real is that trend, though, of companies looking to list in Europe versus the US, rethinking their plans to list in the US? Is that a short-term phenomenon, or is this a real structural change? What kind of numbers are we looking at?
No, I mean, it's a very, very significant phenomenon in London, and I understand why there are so many comments from London-based media, because this is a real phenomenon in London. We don't have the same exodus symptom in Europe in any way whatsoever. So the reality is that European companies continue to list in Europe. London-based companies continue to weigh their options. I can tell you that among the few companies that were waiting 6 months ago or 1 year ago, prospects of being listed in Europe versus the US, I had dialogues with all of them. They are fundamentally revisiting the US options because the level of uncertainty over there. So there is still valuation multiple premium, but there is a huge uncertainty discount in the US. So these projects are being significantly revisited until the dust settles.
And you've announced initiatives to align with the defence spend, it seems, in Europe, coming through from countries like Germany. You've got new indexes focused on defence. How much interest are you seeing for some of those changes and some of those new initiatives? And do we need ETFs focused specifically on defence? Is there more you can do, and is that one potential option?
Absolutely. The reason why we have launched a new family of indices, what I call the new ESG, Energy, Security, Geostrategy, is twofold. Companies in Europe have to be stronger and to raise equity from European investors to build a European strategy, because Vladimir Putin wants Europe to be weak and divided. Donald Trump wants Europe to be weak and divided, but we want Europe to be strong and united. So we are producing tools to capture European savings towards European strategic autonomy projects. In addition to that, there is a huge appetite from investors to capture the value that is going to be created by some companies in Europe that are part of these rearmament projects. And many investors, many asset managers told us, please build tools for us to be exposed to this huge trend of aerospace and defense sector boom in Europe. that's why we have built those indices, and ETFs are being designed to match them with various large asset managers, global asset managers, European asset managers that are with whom we have co-designed those indices. So I'm very excited about the fact that European saving is now going to be significantly driven to all sorts of equity instruments, including ETF instruments, to finance the European strategic autonomy. The same will apply in terms of debt. One day will come when we will have European freedom bonds, European victory bonds, European defense bonds, and that's why we have a platform that is being designed to accommodate the retail appetite for the new bond instruments to fund European defense.
Okay, more coming on the defence space in terms of these capital market adjustments and European defence ETFs in the pipeline. Euronext CEO Stephane Boujnah, thank you, as ever, for your time on the back of those earnings as well. Let's get some other news now in terms of what is crossing the Bloomberg terminal from our teams around the world this Thursday. Bloomberg learning that the UK is drawing up plans for a special visa for foreigners who invest significant sums in Britain. Ministers are considering an investor visa open to people willing to fund strategically important sectors like AI, clean energy and life sciences. The preparatory work comes against the backdrop of a backlash, of course, over rolling back non-dom tax breaks for wealthy foreigners. Microsoft's recently announced job cuts are falling hardest on the people who build the company's products, showing that even software developers are at risk in the age of artificial intelligence. According to Washington State documents reviewed by Bloomberg, software engineering was by far the largest single job category to receive layoff notices in the state, making up more than 40% of the roughly 2,000 positions cut. Coming up, Siemens' second quarter industrial business profit beats estimates. We're going to hear from the company's CEO, Roland Busch. That is next. This is Bloomberg. Welcome back. I'm going to recap lines for you from the industrial conglomerate, of course, based in Germany. Siemens coming through with a beat in terms of net income and profit for the second quarter. The industrial business profit rising almost 30%, 29% year on year to 3.2 billion euros. They benefited from a pickup in terms of factory automation demand out of China, but also orders for trains in Europe as well. Second quarter revenue coming in as a beat. Margins also a beat, and seeing full year comparative revenue at the top end increasing 7%. Let's listen to the CEO right now.
The tariffs this is not stable, as you know. They change from one day to the other, and based on what we know, we obviously dive very deep into understand what the impact on our numbers would be, and the conclusion is here very limited. And here comes the reason. Number one is we have a very, very strong manufacturing all over the world, also in China, in the United States and China. In the United States, we have 80% of local for local value. Then we have measures in place. So in some cases, we're also pushing higher costs through to our customers. We increase the prices as our competitors do as well. In some cases, we have even contracts which allow higher commodity prices to go through to the prices. We work on our cost savings as well. So all in all, the impact on Siemens so far is limited. The largest impact is eventually by Siemens Healthineers, as I explained. And this is a reason why we kept the guidance. There are secondary effects. For example, that the supplier of our suppliers might increase the prices, and that comes to us. Hard to say. We cannot calculate it yet. And of course, if there's higher inflation in the United States and the growth rate would go down, would be an impact too. We took that all into consideration and came to the conclusion that we can keep our guidance as it is so far.
And also looking into the future, because one of the sort of main objectives of the tariffs and the Trump administration is to bring a lot of manufacturing jobs back to the United States, building new factories, updating factories. There has been some skepticism about some of the announcement in terms of how real those sort of deliveries are going to be. You in your digital industries business, this is factory automation. Are you seeing any evidence of a surge in sort of desires? Have you been having conversations with manufacturers who are trying to expand their footprint within the United States? Are you seeing any evidence of that happening?
So not yet is the short answer. Of course, we see some momentum in, for example, semiconductor industries, which are many projects and they're in place and they're ramping up. But if it comes to really manufacturing of any kind of parts for automotive and the like, we don't see it yet. Reason is that the uncertainty on where these tariffs are finally ending is so high that people say, let's wait and see before we invest. Number one. Number two is if manufacturing comes back, we strongly believe it will be highly automated. There are limited trained labor available in the United States market, and that will not change going forward. So what would you do? You would automate and digitalize as much as you can. And this is where Siemens comes into play. We have a very, very strong portfolio, also for the United States, supercharged now with AI technology. We can simulate everything, the products, the plant, before you build it and really drive it in a digital twin way in order to optimize productivity, save costs, but also working with less labor. So therefore, we believe there will be an inflow of more investment in the United States. By the way, Siemens, we invested too. We recently opened a plant in Fort Worth in Texas for data centers for electrification. So we see more coming, but it's too early to say, but it will come.
And moving from the United States to China, the last time we spoke, you started to see a few bright spots within the Chinese economy. What are you seeing in China?
So if you talk the automotive industry, this is really muted, if not China. China is really picking up momentum in automotive industry. We see that, and this pulls a lot of also machine building, machine tools, automation. So there's also private consumption is gradually starting. As I said before, it will not be a step up, a steep step up, but a gradually step up, and we see that China is picking up momentum.
OK, China picking up momentum for Siemens. The CEO, Roland Busch, speaking, of course, to Bloomberg's Oliver Crook on the back of those numbers. To the US right now, and a preview of what to expect from an industrial giant, of course, to what is happening on the retail front and the US consumer, because Walmart reports earnings today, with analysts and investors focusing in on how the world's largest retailer is responding to global trade tensions. Charlie Wells is here with an update. How will, then, the tariff picture impact Walmart? What is the expectation ahead of these earnings?
So, Tom, there's a reason why Walmart is the world's largest retailer, and it's not the in-store experience, it's not the greeters outside, it's not necessarily even the quality of goods, it's price. And one of the ways that Walmart has maintained such low prices is they import a lot of goods. So their CFO spelled out at an investor day last month, about a third of the stuff they sell is imported, and a major import location for them is from China, right? So for this quarter that they're going to be reporting on, it's through the end of April. We know that in that period, those 145% tariffs on China were in place for at least some of that period. So it's going to be really interesting to see kind of how that impacted this quarterly report. And I think the question that we're certainly going to get from analysts is, how do you keep prices low? Or do you have to raise them? Or do you eat into your margin? So I think these questions are going to come up on this call, and Walmart finds itself in a really difficult position.
And that takes us to a broader question, really, about the sensitivity right now of US consumers, whether or not they can absorb higher costs. What are the earnings expected to tell us more broadly about some of the trends rippling through this US economy?
I'm going to name a Taylor Swift song that I think fits this moment. It's called Blank Space. And this is a fear that Walmart executives, that Target executives, that Home Depot executives have been very concerned about, which is shortages. And there is reporting that these executives went to the White House and talked about shortages. They're not going to talk about this publicly. We're not going to hear about shortages. I'm pretty certain on this Walmart call today. But we know that traffic to major ports in the United States, I'm thinking about the port of Los Angeles, where a lot of this China container ship traffic goes to, that traffic has been down. So it's going to be, I think, a big challenge for these companies as they try to navigate this. We know that the trade situation has improved a bit, but still, if you think about China, that tariff rate is still 30%. And so blank space is something that could happen because there's such a lag. So even if all of these tariffs went away, there's still a lag. It takes about 2 weeks to kind of reload these ships from China, 2 weeks to cross the Pacific. And so even if they went away, there's still that impact. There's still that significance of potential potential shortages. So that's the big picture.
I never imagined that we'd be able to tie Taylor Swift to Walmart earnings, but you did it with aplomb. Charlie Wells, thank you very much indeed, with the setup on some earnings out of Walmart that were arguably some of the most interesting for those reasons that we've seen in recent quarters. There's plenty more coming up, hopefully more with Charlie Wells as well through the next few hours. Stay with us. We're back with a breakdown of some of the key market moves in the next minute. This is Bloomberg.
If the increases in tariffs announced so far are sustained, they are likely to interrupt progress on disinflation and generate at least a temporary rise in inflation. The rate has been held at what I view as a moderately restrictive level. I view the current stance of policy as well positioned to respond to developments that may arise.
Federal Reserve Vice Chair Philip Jefferson there on developments that may arise. And, of course, the development that arose over the weekend were, of course, the conversations between China and the US. And that led to 3 straight days of gains for US equities. And you've wiped out, of course, the losses, S&P 500 year to date, back in positive territory. But is it looking a little stretched at this point? There's a bit of a wait-and-see approach right now, filtering through these markets, it seems, for the next catalyst. And maybe that will come through on the trade front. But this is an indication, of course, on the RSI, the relative strength index, that you're getting near that overbought zone for the S&P 500, which arguably is tying in to the views that maybe there's a bit of a breather coming through, particularly round the moves stateside. Let's flip the board and have a look at what's happening on the data front. Maybe this could be a catalyst. Retail sales, there's the focus, of course, on the health of that US consumer. Some expectations from Bloomberg Economics when the retail sales data drops later today that you're going to see a flatlining, essentially no growth in retail sales, having seen a pickup of over 1% from the month before. You may see 2 competing factors. One is a pull forward of purchases, of course, by consumers leading up to and around that Liberation Day on April the 2nd, but also counter to that maybe is a little bit of softness, particularly when it comes to dining out and services. So watch that data later today. Let's have a check-in on what's happening with the tech story, because Nvidia is back in positive territory as well year to date by slim margins, but it's made up for all the losses that came through earlier, of course, and is now the second, once again, taken second place in terms of the biggest company by market cap, just behind, of course, Microsoft, pipping Apple to second place at $3.3 trillion US. Some of that in recent days, of course, around the developments come out of the Middle East in terms of the buy, and Bank of America saying that could lead to billions of dollars in additional deals for both Nvidia and AMD. Stick with us later today. CEO, of course, JP Morgan CEO Jamie Dimon is going to be joining us exclusively for an interview on surveillance, so stay with us for that conversation. But the opening trades is up next. This is Bloomberg.